Hello, thanks for joining Techie Personal Finance Bootcamp. So if you've been listening, I have extended season 1.5. We're going to be talking about taxes because we're heading into tax season for 2020. I also recently launched a new side business for tax filing services for my level up financial planning clients. It's called Power Up Tax Planning Services. So it's something I'm super excited about because taxes is one of the coolest ways that you can navigate things and build new strategies that a lot of times people don't realize or think about because taxes are such a pain in the butt. But hopefully with these few episodes I'm recording, they're relatively quick too. So definitely check them out, give them a listen. You'll have a better understanding of how the tax system works, and as crazy as it is. And so today I'm going to be talking to you about traditional versus Roth retirement accounts. And so there's a big difference. They're pretty substantially different. Traditional type 401ks, traditional IRAs, those are different types of retirement accounts. But the fact that they're traditional means that you will be able to reduce your income for tax purposes. So it's going to be something where if you had $100,000 in income and you put $5,000 into one of these traditional retirement assets, it's actually going to reduce your income by $5,000, which would reduce your taxes as a result. So that's one of the coolest kind of aspects of retirement plans, is there's some additional tax benefits of doing so. It's very different for the Roth side. So comparing the traditional to the Roth, you don't receive a tax benefit by putting funds into it in the year that you make the contribution. So if you make a contribution in 2020 to the Roth, it's not going to reduce your income. It's not going to reduce your taxes for 2020. The crazy thing is, though, is after that point, any growth in that investments inside that account are going to be tax-free. And then when you pull it out in retirement, it's going to be tax-free as well. So that's one of the big differences there. They're actually the opposite of each other. With the traditional side, you receive the tax benefit now, you receive that tax deduction now. With the Roth, you pay the taxes now, but you never pay taxes again. So as you can guess, since you receive that benefit of that tax deduction with the traditional, that means that when you do finally take it out when you retire, you actually do have to go ahead and pay taxes at that point. That's going to be most likely for most of my listeners far into the future. So what happens is whatever tax bracket you happen to be at, that will be kind of the going rates that you pay taxes on. And just remember too that you don't pay your marginal tax bracket on all of your income. I just recorded one of the earlier episodes on that, so go give that a listen. Basically, you pay all of the earlier brackets, the smaller brackets first, up until your marginal tax bracket, which is your highest taxes that you'd be paying. And just really quickly, as far as a strategy standpoint, as far as, well, which one should I do? So it's cool. It sounds like these things both have cool opportunities to navigate your taxes and build up retirement assets and save for retirement. But which one should I use? And so it's hard for me to know specifically your situation, but if you're expecting your income to go up in the future, most likely that means your taxes would go up in the future as well. So that would be a good indication that Roth would be a good situation for at least the next couple of years. So basically earlier on in your career, Roth tends to be more of a no-brainer because you expect that your career growth is going to happen, your income growth is going to happen, and with that, your taxes end up going up. So Roth is usually better earlier on in your career. It gets harder to continue making Roth contributions when your income is high and you're starting to climb those tax brackets. So that's important to just kind of understand that it's not always the case. It's something that you want to review every single year, especially if you have a unique income year. That's another time when it's a no-brainer for the clients I'm working with. If they're in a career transition, some of my clients are bootcamp graduates. And so if you're only have a portion of income for the year because you were in a boot camp 6 months a year, that probably means that your income for that year is going to be really low, which means your tax bracket is probably going to be the lowest it's ever going to be, because once you get into tech, you're going to get a consistent salary, and that's going to be on the higher end probably from even what you had earned previously. So if you have the ability to make Roth contributions or maybe even do a Roth conversion during those kind of unique years, then that's important. The other end too, if maybe you're used to making Roth contributions, but then there's a unique income year, maybe you have RSUs that vest and it ends up pushing your income like to skyrocket for that year, that's when you want to be like, oh, let's do traditional side, reduce our income, reduce our taxes, because this is going to be a crazy tax year. So those are really the only kind of no-brainer scenarios. And then other than that, it's just kind of comparing where you think your income's going to be going compared to where it is now. And if taxes are too painful right now, then just go with the traditional and then look for opportunities in the future when those unique transition years happen to do some Roth conversions. That way you have a little bit of Roth, a little bit of traditional once you are going into retirement, because there's a lot of great strategies and flexibility that having a little bit of both could allow you to do in retirement and actually save you a lot more in taxes by being able to go back and forth between those types of accounts.